QuickBooks Pro Plus Desktop 2022 Sales Receipt Payment Received at Point of Sale. Get ready because we bookkeeping pros are moving up the hilltop with QuickBooks Pro Plus Desktop 2022. Here we are in our Get Great Guitars practice file, going through the setup process with the View dropdown, the Open Windows list on the left-hand side, Company dropdown, Home page in the gray area, maximizing it to that gray area. Opening up the Reports dropdown, Company and Financial, taking a look at the Balance Sheet Standard Report, customizing the report up top with the range change from 010122 to 123122, fonts and numbers, bringing the font up to 14 for font's sake, closing it back, and then okay, yes please, okay. Let's then open up the profit and loss with the reports drop-down, Company and Financial, P&L range change from 010122 to 123122, customizing it with the fonts and numbers, picking that font up to 14. Okay, yes please, and okay. Let's do it one more time with the TB reports drop down, accounting and taxes, trustee trial balance, range change from 010122 to 123122. That's too many twos. I put a 222. 123122, and then customize the report, fonts and the numbers, change that font to 14. And okay, yes please, and okay. So now we're going to do the sales receipt. So let's go back to the home area. The sales receipt is going to be this item. So we're imagining we're making a sale. You can basically imagine like we're at the check register. So we've got our store, we've got our guitars, we've got our equipment and furniture and whatnot, and we're making sales. Now we're making these sales. We're imagining basically inside of the guitar or the store. You can imagine a guitar being brought up, and we're going to be ringing that up. In essence, that would be what the sales receipt would be calculating. It's going to look a lot like the invoice, but when we enter the invoice, that means it's going to be increasing the accounts receivable. The rest of it will be basically the same, whereas the sales receipt then is skipping these two steps, as you can see by where it is in the lineup here. It's going to be going directly to receiving the payment, whether that be cash or some other form of payment like a credit card or something like that at this point in time. So then we still have the situation where we might want to put it directly into the checking account at that point in time, or if we were in a store, something like that, more likely we would want to be using that undeposited funds so that we can then deposit it to the bank at the end of the day. We can imagine walking to the bank, for example, if we're making the deposit, depositing multiple sales transactions that have taken place in a lump sum into the bank. And as we do that, we want to make the deposit ourselves into our checking account in the same grouping. So we're going to have to use that undeposited funds clearing account to do so. Let's take a look at it. We're going to say create the sales receipt here, and we're going to make one. We're going to call it string music. I'm going to minimize this item on the right and on the left so we could see it a little bit more clearly. We're going to call it string music. String music has not been set up, so I'm going to add it as we go. I'm just going to hit tab, or you could put an add new. I'm going to do a quick add here, so we're just going to have the minimal information, although of course in practice we might want to pick up as much contact information as possible so we could send them our newsletter and so on. We've got the option of putting it into undeposited funds or not. If you were in like a store setting, it's quite likely that you would want to put it through the undeposited funds because you might be getting cash in that case, and therefore, or even credit cards in that case, and then therefore those two instances are those where it's more likely you're going to have this grouping situation that you're going to have to be dealing with, because you're going to have to group them when you deposit to the bank, or in the credit card grouping, how the credit card company is going to deposit them into your checking account. So note that this drop, but if you wanted to put it to the checking account, you could do so with this drop down. However, that drop down will not be there unless you turn it on, which is in the edit preferences at the bottom. We're in the payments section, company, and then here's the item that we unchecked. We saw that same option here for the receive payment area. It's going to be the same here for the sales receipt. So that's going to, you have to uncheck that. That'll give you this option. Otherwise you won't have it, and it'll go into undeposited funds by default. I'm just going to imagine the cash again, so we can imagine just grouping the cash together. and making the deposit at the end of the day. Let's make this as of the 19th for string music. And then the item I'm going to say is an ELP. And let's say we sell a couple of them again. So we have the ELP. Let's say we sell 3 of these. And then we're also going to sell, let's pick up another one. And we have the Gibson. Have we sold, let's say, a GSB Gibson item? Let's say we sell 1 of those just to mix it up a bit. And so we're selling the 4 guitars we're going to imagine here, calculating the sales tax. Now, what's this going to record when we record it? It's going to increase instead of, you're comparing this to an invoice now, instead of accounts receivable, it's going to increase undeposited funds because we're imagining we're getting payment in the form of cash. We're going to just put that in the drawer at this point. It's a lot of cash for that transaction, but that's what we're going to imagine here. And then the other side is going to go to the sales. It's not going to include the sales tax, however. It's going to go to just the 1,005 plus the 777 increase in the sales side. The difference of the sales tax, the 113.85, is going to go to the sales tax payable account. We're also going to have a decrease to the inventory by an amount not on the sales receipt, but driven by the item, just as we saw with the invoice. And the other side is going to go to the cost of goods sold for the inventory, recording the cost of the sale that we're making on a perpetual system. We'll also have the sub-ledger reports of accounts receivable. Actually, accounts receivable is not going to be impacted, but the inventory, tracking the decrease in the inventory by units. Okay, so we have our sales tax item calculating here as well as the default for the sales tax because these items are set up as taxable items. Let's save it and close it and check it out. Save it and close, opening up our little caret over here. And then let's take a look at our trial balance, the easiest place to search these items. So we'll then go say that the undeposited funds should be going up again. Undeposited funds, there it is, sales receipt increasing at this time as opposed to the payments. If I double click on it, we get the full amount of the 2390.85, closing it back out and closing out the transaction detail. The other side going to sales down here, double clicking on the sales item. We see the sales items listed out by the 2 sales items that were sold, double clicking on it. We see the 1,005, the 777. It's not including the sales tax, which is the 113.85. Closing this back out and closing this back out. The sales tax then is in the payable, which is going to be in the payable for the sales tax payable right here. Double clicking in it. There we've got this sales receipt recording the sales tax payable on the transaction for the sales tax. Let's close it back out. The inventory also going down. That's going to be an asset decreasing. Double clicking on it. Then we've got the decrease in the inventory for the 1,200, the 598. If I double click on that, the invoice doesn't show those 2 numbers. They show the 1,005 and the 777, but the sales receipt is still being used to calculate the decrease in the inventory. It knows to do that on a perpetual system by the fact that the items are driving that transaction, and we don't want those costs to us on the sales receipt in essence. So I'm going to then close this back out. Then close this back out. The other side's going to go to the cost of the goods sold. Cost of goods sold down here in an income statement area. And so there we have it, and there's those 2 items for the sales receipt. Closing it back out. You can see the same kind of thing if you go to the balance sheet. If you go to the balance sheet, just to locate the accounts that were impacted, we've got the undeposited funds here, other current assets. We've got the inventory, other current assets. We've got then the payable for the sales tax payable. And then on the income statement, otherwise known as the profit and loss, P&L, we have the sales impacted and the cost of goods sold. Difference between the sales cost of goods sold being the impact on the net income as well as the gross profit. So let's go back to the balance sheet. One other thing to check here. That's going to be then the inventory subsidiary ledger, tracking it by unit on a perpetual inventory method using the weighted average. Reports drop down. Let's go to that inventory item, inventory valuation summary, date at 12/31/22. And there we have, it's now at the 38,878. So we're at the 38,878. If we tie that out then to the balance sheet, we should still have the 38,878. We can also look at the detail if we wanted to go to the inventory on the inventory valuation detail for 01/01/22 to 12/31/22, and then we could see the activity that has been happening thus far by the inventory units. So, and we looked at the sales receipt. It looks like the sales receipt for the GSB and the other sales receipt for the ELP. Now let's do another one, and imagine this time we're not going to have inventory items, but just service items. So I'm going to go back to the home page. These service items sound a little bit funny. They're kind of like service items you might see that are kind of generic. But the idea now, we're going to have service items instead of inventory items, which we could bill on the invoice side of things, which possibly would be more likely because you might be in a situation, if we're talking about our situation here, where we're going to do the work and then bill the client for the work that's done, similar to like a law firm or a legal firm. Here, we're going to be doing service items on the guitar, but we're going to imagine they're coming in and to the sales receipt area, asking for the service items. We're going to do the work at the same point in time and provide them the service at that point in time and charge them for it. So let's create the sales receipt then and do a similar type of process for the service. We're going to imagine this is going to be for Sam. I'm going to type this in, Sam the Guitar Man. That's going to be their customer. We're going to add that. We could add it here. The is spelled wrong. At least spell the right. You know how to spell the, don't you? I can do that one. If I spelled anything else wrong, then I apologize. But the I can get. Okay, so we're going to then tab quick add on that one. Quick add. It's going to go into undeposited funds again. I'm going to call it cash again. We're then going to say it's on 1/19/22 again. And then down here, we'll sell another ELP, let's say. Actually, we're not selling inventory items. We're selling service items this time. That's the point. So if I hit the service items, let's say we got a diagnostic, which sounds more like a guitar, like a auto type thing. But let's do a diagnostic. And I'm going to say 10 of those on the diagnostic. I'm going to say that we have then hourly service. So I'm going to say we have some kind of hourly service, number 1. And you can imagine whatever that would be. We're tuning up the guitar, shaving the guitar, or sanding it, or something for the guitar that we're charging. You could say we're charging by hour, we are imagining. And you could see this as similar to like a law firm or some other firm that had kind of a job cost system where we might be billing out the time of like a staff, a partnership kind of setup where the partners basically are then working the staff and billing out the staff's work on it. So in here you can imagine basically they're doing some kind of restoration of the guitar possibly or something like that and charging for the hours that are at. And we're going to say 15 here. And then we're going to say that the other is going to be tuning. What did we say? Tuning support. And so it's another going to be, we're going to say 12 for that one, just to charge some of these service items and practice the recording of the service items. Now remember, as you look at the service items just in general, it would be nice if you had more specific type of service items possibly than just an hourly service item. If you're in like a law firm setting, or if you're in like a bookkeeping setting where you're like a partnership kind of setup, which many law firms and CPA firms are, then you kind of have to bill the staff of the time. That's kind of the point. The staff then is going to be working, and you typically bill the staff time. But you could structure it differently than that. You could try to say, I'm going to structure it, for example, by a set amount of the work that's going to be done if you can quantify categories of work, like how many transactions are going to happen or what kind of services are going to be provided. That's more difficult when the service is not defined. You don't know exactly what you're going to do. Like if you're taking on a legal case and you don't know what it's going to contain, there's no way to basically get into it other than to basically charge on an hourly rate. If you were to do sanding of a guitar or something like that, again, different types of things would probably take different time. So it might be hard other than to basically see what would be constituting the job, what would be needed in terms of the parts and whatnot if you're going to rework a guitar or something like that. So sometimes the hourly rate or some kind of job cost system with the actual materials would be necessary, but I won't get into that in much more detail here. Just be aware of your billing time and how much time you're going to be in on the billing and setting up your items to make that as easy as possible. Okay, so what's this going to do? It's going to increase undeposited funds. The other side's just going to go then to the sales, but not to sales for the sales of inventory, I think we charged it to another account called service items, which is driven by the items here. There's going to be no impact on inventory. We're not charging sales tax on it because it's a service item that's also driven by the items. Let's save it and close it and take a look at it. Tuning, it says it's misspelled. Tuning. I'm just going to leave it. I'm going to ignore it. And then I'm going to say okay. And then we're going to go to the trial balance and check it out. So now we increase the undeposited funds again, double clicking in on it, increasing the undeposited funds for Sam the Guitar Man. There it is, double clicking on it. There's our sales receipt, closing it back out, closing this back out, the other side going to sales. But this time we put it to another revenue account called service revenue. And it went to another revenue account because we told it to when we entered the inventory item, double clicking on it. And so there's the items that are set up here, no sales tax involved. So in that instance, or in that sense, it is easier. On the balance sheet, you could see that same information on the balance sheet. You would say, okay, what happened is undeposited funds went up. The other side then is on the profit and loss, which we now have another category in the sales area, which is going to be the sales revenue. So now, if I go back to the home page, we now have 5 items in this record deposit. I think 3 of them were from the received payment and now 2 of them from the create sales receipt, which we would imagine going to the bank at the end of the day and depositing into the bank and grouping them in the same way that we're going to deposit. That's why we got this pop-up field here, and we'll take a look at that in future presentations. Closing this back out and closing this back out. So we've done the invoice to the received payment, and now we're jumped up to this sales receipt process, and then we still have that last component, taking them out of undeposited funds, putting them to the bank account, which is not just important to get the financials right, but also important to make the reconciliation of our books to the bank's books as easy as possible.